I've been involved with the VIX for years. VIX was created in the early 90s, and futures were launched in 2004. In 2006, the CBOE launched options on the VIX. My company, Group 1 Trading, was the designated primary market maker for options on the VIX. So the historical average of the VIX is around between 16 and 20. So it's definitely come in a significant amount since the year-ago highs of 89. Since then, we've seen the market be considerably less volatile, and in my opinion, the VIX has actually done a really good job tracking the overall volatility level in the marketplace, which is what it's designed to do. So as the market has rallied and gotten considerably less volatile, the VIX has moved down in concert with the less volatile marketplace. The actual level at which the S&P 500 has been moving volatility-wise has been between 15 and 18 over the last few months. And so the fact that the VIX has actually been trailing off from around 24 to just above 20 really, in my opinion, isn't as significant as people are making it out. That being said, the fact that there is still a significant spread between where the S&P 500 index is actually moving volatility-wise and where VIX is predicting it to move over the next 30 days means, in my opinion, there's a healthy amount of skepticism still out there with respect to how real this equity rally is. And you certainly hear a lot of that in the news with respect to people not feeling comfortable with the level of the market right now. There's been a lot of talk lately about complacency in the equity market, and people have been pointing to a reading of 20 in the VIX as a reason for or an indicator of that complacency. A reading of 20 in the VIX effectively means that over the next 30 days, the market is expecting the S&P 500 to move roughly 1.25% per day. The S&P 500 has actually been moving significantly less than that over the past 6 weeks, and so that's, in my opinion, the reason why I don't think that's a sign of complacency. I just think it's the market coming to terms with the reality that the actual volatility is still significantly discounted to where the implied volatility is. One of the things I always like to talk about when I discuss VIX is the fact that I really think it's an extremely powerful tool for investors. So you can watch a financial channel or listen to a pundit or read a financial reporter, but that really only gives you access to a limited number of opinions, and it's really hard to sort through and dictate which opinions are good, which opinions are bad. The really nice thing about VIX is that it is the best place, in my opinion, to get the market consensus on what's going to happen with volatility, which is a very good indicator on whether the market's going to go up or down. So I think that using VIX and using the term structure of the VIX futures, which you can find on the CBOE website, is a really great way for individuals to look at and get the market view of where volatility is going to be. And people are actually, this market view is generated by people buying options, so they're putting money at risk to give these opinions, which I think is far more powerful than someone giving an opinion on a media outlet.